Hi, I'm Victor Cantore. I'm the president and CEO of Amex Exploration, and thanks for joining us today. I really want to show you our project. Lots of exciting news going forward. We just recently put out a PA. We put out there's been a lot of press releases over the last in the last quarter. And just to show you where the project is located, we're right in the middle of the Abitibi Greenstone Belt. Our project is where this red star is, and you have Hecla just north of us. There's a detour with Agnico Eagle. There's a Holt Holloway south of us. There's the Westwood complex, and then as you continue going east, you have Valdor. That's where our partner runs the Lamac mine. And the reason I'm showing you all this is really to show you that when we put together our strategy to do 4 or 5 years of toll milling, that there's actually optionality on the toll milling. We can actually pick and choose where we want to send it, which is something that we're doing right now. So that's what I say. Stay tuned. So now, if I focus back to where we are, not only are we in the center of the Abitibi Greenstone Belt, where we are actually, it's a former mining town, and what you see there on the right side, you see that's the old tailings that's there. We're not going to touch that. It's totally rehabilitated. And that's where you can tell where mining can coexist with the people. If you look here, all these houses were bought up and built after this tailings dam, and our project is really close to the city of Norma, or the town of Normatal. You have a transformer electrical station. This is hydroelectricity. It's only about 5 kilometers away from our project location. There's an access road. There's the core shed. There's also I can go into the core shed. It's right in the town. And recently we put out a resource calculation. And so when you look at our resource calculation, it's quite impressive. We have a total of 2.3 million ounces. The average grade on everything is you're looking at 5.44 in that range, grams per ton. Pretty high grade compared to a lot of deposits today. In measured and indicated, we have 1.6 million ounces, and you're looking at 6 grams per ton. But the real star of this is really the Champagne zone. The Champagne zone has 831,000 ounces in measured and indicated at 16.2 grams per ton. And when you look at that number, I mean, 16.2 grams per ton, that's a half an ounce per ton. And that's what really makes this project, that's how the economics really move forward. And again, the reason we've put out the reason we put out a resource is, with 2.3 million ounces, that we can actually go into production. There's a strategy how we're going to do it. We're going to phase it. We're going to lower we're going to mitigate the technical risk. We're going to mitigate the financial risk. And you can only do that if you have this type of deposit. You have to have a high grade deposit, and you got to be near a town where, that's hundreds of millions of dollars of infrastructure that you're saving just because you're there. And you're close enough to take advantage of all that, but you're far enough not to disturb the city. So that's really been exciting for us. If I look at the highlights, so the way we're planning it is we're planning it in phases. There's a phase one. We're looking at a full year, 1,000 ton a day contract mining. Phase two, and if I go through the numbers, it's really to show you the initial capital cost. You're looking at 146 million. There's going to be pre-production revenues of 68 million. And this is not small production. You're looking at 102,000 ounces a year in phase one in the toll milling, and with an all-in sustaining cost of about $1,165 per ounce. I mean, if just for simple math, if you're selling gold at 3,200, which is still way below where it is today, you'd be making $2,000 an ounce. You take $2,000 an ounce on 100,000 ounces, that's $200 million US. In Canadian dollars, that's $280 million of free cash flow for a stock that's we have a $370 million market cap. The diluted head grade that's going in is going to be about 10 grams per ton, and then phase two. You're looking at it's another 13 years, but phase two, we always have to know and understand that we are in an active exploration program, and we do expect to find more ounces and increase all that. Now, when you look at even at that, you look at the diluted head grade, you're looking at 4.32 grams per ton. That's quite, those are good numbers. Life of mine, 17 and a half years. I mean, it's basically a generation, and that's really good, because when you're looking at permitting, and you already have a town that's there. Just there's also the town of Lassar. It's got 12,000 residents. It's only 23 minutes south of us. I mean, they want a mine that's gonna last 17 and a half years, is actually a generation, and we're gonna continue moving. That forward. Now, these are the highlights, but if I jump right into the numbers, quite impressive, along with sensitivity analysis. Um, at $3,400 gold, which again, gold's trading at 39 to 4,000. It's been trading in that range, lately. I mean, you look at these numbers. For example, a pre-tax total free cash flow is $5 billion. That number is 5 billion with a B. If I go to the post-tax numbers, you're looking at a post-tax NPV of $1.8 billion. And again, I got to remind you, $1.8 billion, and you're trading at $370 million. Your post-tax IRR, is 107%. Your payback period, this is after tax payback period, is zero point 0.4. And then when you look at the ratio of your post-tax NPV over your capex, usually two times is good. The project passes. 4 times is fantastic. Well, the way we've designed this, basically we're at 13 times. It's really impressive numbers. And so just to show you now this is our Gantt chart, how we're going to be putting everything into production. So we did talk about, there's two phases. There's a phase one and a phase two, but before that, there's a bulk sample. So we've already announced that we've deposited our permit for the bulk sample. Normally, it takes 3 to 6 months. We're actually expecting it within that timeline, and hopefully sooner than later, maybe as early as sometime this year. So our first thing is we did put in a PEA update. We're expecting the permit sometime at the end of this year. Then it would be construction. So you'd be constructing for 15 months here, and by 2027 you'd be extracting the gold. Now, we've applied for a 40,000 ton sample. When you're pulling in, what would be coming in there, a diluted head grade, is going to be about close to half an ounce. That'd be coming out of there. So if you get your 40,000 tons, you'd actually be producing 20,000 ounces. In Canadian dollar terms, that's about $100 million. If you get 20,000 tons, it's still $50 million. So why I'm talking about those numbers is because when you jump into phase two, for example, so we've already started a feasibility study for the phase one of the project. And we're going through all the environmental impact studies, the authorization, the BAP. That's all happening right now. And we're expecting, under the normal timelines, we're expecting this to happen by 2028. So we would need that capex of $146 million at that period. But you got to remember that the money that's going to be coming in from the gold sales, that's going to go against it. So whether it's 50 million or 100 million, that's going to dramatically reduce that number. And also on the 146, we're going to be using about $30 million to build the underground, the above ground infrastructure, the below ground infrastructure, so our decline, our portal, and that's already a sunk cost. So you're going to reduce it from that. So it's quite interesting. It's the way this is done. You're mitigating your risk, both from the financial part and also from a technical perspective. A lot of times where there's delays and failures, it's in your tailings management facility. There's no tailings management facility definitely not at the beginning, and even our plan right now does not contemplate one, because we were going to be backfilling that into the open pits. And the other thing is sizing your mill. I mean, after 4 years of mining, you're going to be able to size your mill properly. And then the third part at the bottom where you see it there in purple, that's when we would have everything back up in production. But by then, I'm expecting numbers to change. Things will get bigger. There's an active exploration program going on. We've purchased. We've purchased on the along the Greenstone Belt on the Ontario side. We've purchased another 152 square kilometers. So now we have a total of 197 square kilometers. And what we feel, one of the reasons why we bought it is that where all the gold is on the Quebec side, where you see it's in red. The age of that rock is pretty much the same, and our geologists feel that there's a mirror image on the other side. There has been past gold showings, including from sonic drilling, and even on the Quebec side. I mean, everything is still. All the zones are open in one way, in one shape or another, whether it be one is open to the depth, one is open on the east, one is open on the south. So again, there is exploration that's going to be going on the Quebec side. There's going to be exploration that's going to be going on the Ontario side, and we're also actively looking for more acquisitions along this belt. Like we've got even though there's a lot of mines around, this is an underexplored area. We've already proven that there's 2.3 million ounces minimum now, and we're going to continue going going along that path, finding more and more ounces. Our capital structure is really nice. You're looking on a fully diluted 145 million shares out. If you look at the amount of options that are there, the amount of warrants that are there, right now there's 141 million, but when you take everything fully diluted, and the options that are there are all $3.25 options. So there's still a lot of money. There's still room. There's still room. There's still room to go. 4 analysts that cover us. Eldorado. Something that's really telling is the fact that Eldorado, our last financing, so we're fully financed. We raised $37.25 million a couple of months ago. Eldorado increased their position. They went from 9.9% to 17%. Eric Sprott is a little over 10, is a little bit over 10%. And you see the management numbers that are there. What's really nice also is to see our this is all on the Quebec side. You look at here, every purple sphere that you see here it's all 10 grams or more. We've gone all the way down to this is 1.4 kilometers, and we've also shown that the system is open. We've drilled the hole all the way down to 1.6 kilometers. The deposit is quite nice. It's pretty much like the Champagne zone is pretty much vertical. When you look at this picture here, like it tells all. The area here going straight down, that is the Champagne zone. The slopes average 4.7 meters. So by no means is it thin. This is definitely mineable when you're looking at 4.7 meters, and it comes down at a vertical depth of about 85 degrees. It's got good grade continuity. The geology in the Champagne zone is easy to follow. And one of the last things is you got to ask yourself, well, what about metallurgy? Metallurgy is very important. So here you have the metallurgy. We've done on the Champagne zone. You get 99% recovery on gold and silver. It's really free gold. So what we've done is like even the silver comes in, like, so we don't talk about the silver. Silver is going to be, it's extra. It's going to come in as a credit. It flows with it. I don't have to do anything different. And I didn't want to do any gold equivalent numbers. This is really a gold project. Even just the recoveries in, when we gave the 3 composites, more than 75% of it was recovered through gravity. That's really impressive. So that's for the Champagne zone. So again, the study, we did it at 95%. When it comes, we've done all the other zones also. So what you see here, the first set, the gravity float, and flotation. If you look at these numbers again, they're well 97, 98%. Probably the average is probably in the 98% or so. And the numbers on the side are for the silver, but for the silver in these zones here. So the silver is a lower number, the recovery in these zones here. But again, it doesn't affect our economics because we don't include them at all. But the silver that's in this zone here, in the Champagne zone, you do recover it. You do recover it at 99%, and that's going forward. We're going to be doing a lot more exploration. We've got 100,000 meters of exploration planned from now till the end of 2026. A lot of news coming in, as we sign the agreements with the Quebec First Nations, as we sign agreements with the First Nations on the Ontario side. It's very good groups. Both are great groups to work with. Open for business. Everybody wants a mine on their site here. Especially something like this, that the majority of it is underground. And as we're exploring, also, expect new numbers. New discoveries to come out. So, and I think that's pretty much our story right now.
So, Victor, could you tell us about yourself and tell us a little bit about your career?
Yeah, so I used to be in the 90s. I was an investment advisor with RBC Dominion Securities, and then I moved over on the exploration side. Looking for projects to. I love taking projects from zero and taking them out to sale or moving them to production at the end of the day. That's really been my career is building companies.
Could you mention a company or two that you have been involved with prior to coming into Amex?
Sure. So just before Amex, it was Nemaska Lithium. That was my project. I had it. I sold it to Nemaska Lithium. I stayed with them. The project is still going forward with Rio Tinto and the Quebec government. It's one of the better deposits. It's one of the better deposits in the world right now. I'm also the chairman. I still am the chairman of Northern Superior. We just got taken out by. We just accepted a buyout offer from. I am Gold. So that was a nice. That was $375 million win. And I want to just continue doing that.
How large is your equity stake in Amex, and how important is it to your overall net worth personally?
Oh, it's quite that. So one thing that's really important is that we bought and paid. Like, I bought and paid for all my shares. There was no land transaction or anything. Like I got involved with Amex at the end of 2016, and my position was zero, and I bought all my shares through either private placements or open market transactions. And I'd like to buy more open market transactions, and with drills running and never knowing when you're expecting to get the permits, and it's all material information. But any opportunity I do get to buy shares in the open market, I do step in.
So how many shares do you have, and also how many options do you have?
Yeah, there's four. I control just under 5 million, shares, and options. There's not that many right now. I believe I have like 300,000 options at 325. Somewhere very close to that number. And the shares is just slightly under 5 million shares.
Could you tell us about the team of Amex?
Yeah. There's a Pierre Carrier. He's currently our COO. He's been involved in many public. He's been involved in many public companies going forward. We brought in Phil Brummett. He's an ex-Lundin mining engineer. Knows underground mining. He's put mining together for quite a while. He came into the project as one of his first statements that he said was, this is a tier 1 world class asset. Like it's so difficult to find 800, yeah, I'll call it a million ounces. Like, it's so difficult to find a million ounces at that kind of grade right beside a town. It's here. I could call it a unicorn. It's very rare you can find something like that. So we brought in Phil Brummett on the team, actually on site working. We have a person called Jonathan Gagne. He was one of the engineers over at the Greenstone mine that's owned by Equinox on the Ontario side. He spent 5 years there building that mine. So he's been in charge now. He's been leading. In the background, he's been leading the company to on bringing this thing forward to production. Again, if we actually get there, but we will. We are moving forward. We are moving forward to that.
And then who's your VPX and your VP Corporate Development?
So my VPX is Aaron Stone. We had him. He actually worked on the project in 2020. He was working with our geological consultants, and so we finally brought him over. He knows the project. He knows the project very well. Our VP Corporate Development is someone I've been working with for a long time. It's Wanda Cutler. You'll definitely see her in the conferences, and she travels around, telling the story and being in contact with most of the producers to show our project.
Excellent. So, could you walk us through the history of Amex? I mean, how was it founded? How did you get to where you are today? And also, I think it would be good to mention the turnaround that you have done since publishing the maiden MRE, which was a disappointment.
Yeah, absolutely. So I got involved in late 2016. We really liked the project. Unfortunately, then Agnico Eagle was involved in the project, and they were involved in the Perron project. So they had an option to move this thing forward. So they dropped it in 2017, which was actually a good thing for us at that moment. They did all the right work. They just were, they got focused on a different project. I mean, this project here, if I back up a little bit more, this project goes all the way back in the 90s. It was with Falconbridge, which today is it was a deal signed with Falconbridge in 1996, 1997, which today is Glencore. So there's been always some sporadic, drilling, work being done like on a much smaller scale. So when we showed up, that's what I really liked the project. We put a much more aggressive exploration program together. And if I fast forward, we're basically we've spent over $125 million now on the project. That's how much has gone into the ground. I'm talking about $125 million of drilling, exploration, geophysics, everything to try to find as many ounces as possible. If I so in September of 2024, we put out our initial MRE. Then we put out also a PA. The PA numbers were good. We continued doing drilling. It was disappointing, but I think the disappointment, I haven't figured it out. Was it a communication issue? Whereas we didn't make the market understand how good this project really, really is. So we continued drilling. We put out a brand new MRE. And the big difference between the old MRE and the new MRE, yes, there was an increase in ounces. We went from 1.6 million ounces to 2.3 million ounces, but the grade substantially went substantially up. Then the economics was really a lot better. But on top of that is the fact that you have, we went all the way up to 1.6 million ounces in measured and indicated. And usually measured and indicated, you can convert that into proven and probable. So the phase one, for example, when I get asked the question, do you need to do any more drilling in the Champagne zone for phase one? And the answer is no, because it's been so densely drilled that we don't need to, I don't need to spend money on drilling. That's where we're just moving forward to it. Whereas when you put out the first one, and you had about 300,000 ounces in the Champagne zone, where the Champagne zone now you have 831,000 ounces in measured and indicated. Before you had like 300 and something thousand. So the market was saying to themselves, well, that means you're going to have to, in order to move this forward, you're going to have to, you're going to have to do X amount of drilling. So you're going to have to get more money just to increase the confidence in the MRE. So I think we overcame that really well, and put together a really robust, realistic plan. To become a producer where you be making hundreds of millions of dollars of free cash flow.
We'll come back to the MRE, and we will also definitely will come back to the Champagne Zone, the mining of that. But so 2.2 million warrants are out. What's the expiry date, strike price on those?
The expiry date, there's about 1 year left on those. They expire in October of 2026. The strike price on those are a dollar 40.
Perfect. And so Eldorado, a $5 billion gold producer, they hold 70% of you. And they, as you mentioned, they went in for 17.6 million the last financing, increasing their stake. They have already been investing a few times. What's their interest in Amex?
They know high grade. I mean, if you look at our MRE, well, actually, if you look at the PA that we put out, the first one, and you would look at the PA that was done, that Integra, what they had bought, the Eldorado bought Integra, and you look at the PA that was done by Integra for the Lamaque zone, or for the Lamaque project in 2017, they look like twins. They're very similar. That's really what they see. They see another Lamaque. They see another Lamaque there. They love high grade. They definitely high grade. You look at the Lamaque mine. It's quite impressive. It's pretty much it. I think they've got pretty much similar grades to us. I think we still have a higher grade, but that's what I see. And we're in on a deformation zone that we're pretty much, we own a large part of it. I mean, we own right now 200 square kilometers.
So what's the financial position right now?
Yeah, we're sitting with close to $40 million, which about 27 million of that is in flow through dollars, and we're sitting with about 13-14 million dollars in hard dollars. So we're great. I mean, this is going to lead us to a 100,000 meter plus drilling program, exploration program for all the way till the end of 2026, and this is moving us forward to getting our permit, in moving it forward. We're pretty well cashed up right now.
What's the annual G&A roughly?
The average G&A, I would say, I mean, it's been going up because the environmental people that you're hiring and all that. It's not considered exploration. I'd say it's about. I don't think it'll reach. It's probably around the $2 million a year.
How much do you expect? So you will be drilling 100,000 meters. You've already drilled. Essentially, where I'm getting is how much do you expect at the cost, or what's the all-in drilling cost per meter here? Really all in?
Yeah, the drilling costs have come down. A little bit. When I look at all in, I'm expecting it to be a little over $200. Somewhere between 200 to 250, more or less in that range. So that's why 100,000 meters is you're looking at $25 million. We're sitting with a little bit more than that. So we're going to try to dedicate most of those dollars to actual drilling, but there's going to be a lot of work that's being done on the exploration side.
What's the high level objectives with the 100,000 meter program, and give some sense of how you're allocating your meters? Is there any infill drilling?
Yeah, so they're going to start on the Quebec side, looking to expand on the. Like I was saying, all the zones are open in one way or another. So there's going to be drilling that's starting there. So first on the Quebec side, as we get our permitting on the Ontario side, we've been doing some exploration work there. So as we complete that exploration work, groundwork, preparing it for drilling, we're really confident that the Ontario side, should bring in some really good results. We're seeing a mirror image on the other side of what's going on here. So a lot of the you'll be seeing it in press releases coming out for the initial ground exploration program, and then we gotta drill it. I mean, the goal is really to continue. So it's two pronged, right? So one is that we're gonna move forward with putting this project into production. It's an aggressive program. By 2027, we should have our first pour from our bulk sample. But at the same time, you're moving forward. Moving forward with exploration, an aggressive exploration program. Once you've built your phase one, for example, then you could really get into an aggressive exploration program. We have 200 square kilometers here, and hoping to grow it, because then you could run aggressive exploration programs with your free cash flow. So you're going to limit the dilution that's going in, and that's really where our strategy is. It's a two-pronged story.
Well, thank you for being here today, Aaron.
Thank you very much, Jasper, for having me. Always a pleasure.
So, I guess first of all, could you tell us about yourself and about your career?
Yeah, sure, absolutely. So you can probably tell by my accent that I'm sitting in our Montreal office today here in Quebec. I've been here since 2017, so about 8 years now. But you can probably tell by the accent I'm not originally from the north. I'm from the deep south, we'll call it. So originally from Australia. I did my geology degree, well, actually specifically mineral exploration and mining geology. But then worked a bit at the bachelor mine for Bonterra as well. And then after that, so the relationship between myself and Amex is actually that I worked as a geologist on the Perron project just after the COVID lockdowns in 2020 for a good 6 months or so. So I was doing the 2 weeks on, 2 weeks off out of Normantal. So I logged a lot of the core myself and lived in Normantal on those rotations. So got to know the project pretty well, and now I've obviously come over to the management side, been in the VPX role here at Amex for a couple of years now. So done the full circle. Perfect.
So before we go into the details of each individual deposits, if we zoom out, could you give us an overview of the geologic setting for Perron and Perron West, and also give some overview of where we are at in the Abitibi and
no, absolutely. So maybe to start off with, I'll just bring up the map of the entire Abitibi to see exactly where we're located. So obviously in the red star here, we've got the Perron property. So kind of smack bang in the middle of the Abitibi greenstone belt as a whole. So kind of roughly a 8-hour drive from either Montreal or Toronto. Very easily accessible via road. We're located right next to the town of Normantal, which was an old mining town built for the Normantal mine, historical VMS mine that you can see the grades here. It was a mine from roughly the 30s to the 70s down to a depth of 2.4 kilometre. And then right in the middle, we're located along what we call the Jacoby Break or the Jacoby Deformation Zone. So as you can see here, there's no gold dots on that map, right? So in the past, this was thought to be a VMS only producing belt. It's called the Greenstone Belt we're located along specifically is called the Normantal Burnt Bush Greenstone Belt, which we'll obviously zoom in on in a second. So obviously the Normantal mine, there's a couple of other satellite VMS deposits as well that have been found in the area. And in the past, it really wasn't believed that there was any gold to be found in the area. So kind of a lot of the historical logs that have been over both on the Quebec side and the Ontario side, the black and white handwritten logs from the 70s and 80s and stuff like that, sometimes would come across metric quartz veins, even sometimes with sulfide mineralization in them, and not even bother sampling them, because unless the geologists back in those kind of Falconbridge years off activity in this area, if they didn't see massive sulfides in the core, they weren't really interested in it, and they didn't believe in the gold potential of this belt. So obviously, since the discovery of the Champagne Zone in late 2018, and gold had already been discovered on the property before that, I believe the Gratien Zone is actually the oldest discovery on the property and was, I believe, made in roughly 2007 to 2009 type of time frame, but not as high grade as the Champagne Zone, which is really what kicked off such great activity for Amex and the 500,000 plus meters that we've drilled since that discovery in 2018.
Perfect. So could we zoom into? I think this is a good slide to start with. If you could explain what's driving the mineralization here, what's the geologic properties of Perron, and the main rocks essentially that you have here and host rocks.
Yep. So this is the basic geological map of the Perron property, and as many people may know, we've now expanded the property quite significantly with the acquisition of Perron West that now goes into Ontario along the same Normantal burnt bush greenstone belt. So we'll zoom out after this as well and look at the regional setting. But the original Perron property is outlined in black here. And so the younging direction of the geology is to the south. So we have our oldest rocks to the north and our youngest rocks to the south. So, you can picture that everything was laid down originally horizontally with the volcanics complex to the north. Then this, what we call the Beaupré block, which is a rhyolitic dome, which, as you can see, contains essentially all of our mineralized zones to date, with the exception of the Gratien zone number 10, which actually has some mineralized lenses within the mafic volcanics of the Normantal South block as well. We then have so a rhyolite is a felsic volcanic, kind of I don't want to say unusual, but atypical to have orogenic gold deposit in felsic volcanics. I would say, like if I had to guess off the top of my head, I would say roughly in the Abitibi, you'd probably have most of your, probably 80 to 85% of your orogenic gold deposits found in mafic volcanics. So what we have in the green here in the Normantal South block, and then kind of probably 15 to 20% would be in felsic volcanics, which is what we have with the rhyolite of our Beaupré block. So this volcanic, mafic volcanic block to the south is still remains very heavily underexplored. So a lot of regional targets down here that still hasn't been followed up on. If we keep going to the south, we've then got the Jacoby Fault, or the North Jacoby Fault. So this separates the volcanics from the sediments to the south. So the sediments of the Jacoby group. So this is really the main break or fault, as we were discussing before, that separates the sediments to the south from all the volcanics to the north. So, like I was saying, all of our mineralization so far, well, the bulk majority of it, has been found within this rhyolitic dome of the Beaupré block. So our 2.3 million ounce resource essentially is all located within a roughly 3 to 4 kilometer strike length from the Gratien zone in the west to the team zone in the east, which is number 6. And then I would say the entire Beaupré block probably stretches for roughly 8 to 9 kilometers of strike length. So,
and are these deposits, are they striking the same direction, or does that vary?
It does vary. It does vary. So our Champagne zone, which is obviously our most important zone, it's a really narrow vein, high grade system. Strikes east-northeast, 80 degrees. So that definitely seems to be an important, obviously, orientation for us. And then, that's one of the really important orientations on the property. Some of our other ore bodies also strike at that orientation, but then we have other lenses mineralization, such as in Gratien and Grey Cat, that more have an east-west orientation for the mineralized wireframes. So those are probably the main two important orientations in our known zones. There are others locally, but those would be the main two to focus on.
And are all these deposits orogenic deposits? And no VMS, what we're looking at here at least?
Yes, so we do. That is a very important point as well. So we do have VMS mineralization on the property as well, and that's what we're trying to highlight with the blue dots. So number 11 is the QF zone, and that would be probably our most important VMS discovery that has been made on the property. That is found in that blue package of rocks there that sits just to the north of the Normetal fault, as we can see here. That's actually called the Normetal mine horizon. So it's the exact same package of rocks that the Normetal mine was located within. So if you follow that blue package of rocks about 4 to 5 kilometers to the southeast, back in this direction, you'll find the historic Normetal mine. So kind of not very surprising that another VMS discovery was made in that geological setting. Typically, these black smokers, as we call them, that form these VMS deposits usually pop up systematically when they're in that underwater environment. It's not an exact science of every kilometer or whatever, but they do pop up fairly regularly when that mineralizing event was going on. So there potentially would be others to find as well along that blue horizon, and potentially into the Ontario side as well on the other side of this pattern Pluton that we have here.
And are the VMS deposits, those are not included in your mineral resource?
No, you're exactly right. So far, all we've modeled up is the gold.
So the QF zone, is that at what stage is that? What kind of grades do you have?
So this just zooms in on the mineralized footprint of the QF zone. It's found at about 500 to 600 meters in depth. As you can see here, we haven't put a whole lot of drilling into it yet, so it's fairly early stage. And I think kind of Victor and Amex as a whole didn't want to confuse the market too much with multiple assets. We wanted to really focus on the gold mineralization, build out that resource, and then obviously back it up with all of the economics that we've done, and obviously now pushing on with a feasibility study for the first phase of the proposed operation. So as you can see here on the longitudinal, we've probably put about 10 to 15 drill holes into it. So very early stage, but as you can see here, like some quite healthy grades and thicknesses. Definitely seems to be more copper rich than zinc rich at this point in time, which kind of makes sense with a lot of the other known VMS bodies in the area as well. Typically closer to surface, they locally have tended to be more zinc rich, and then as they get deeper, tend to be more copper rich. So we're at about 600 meters depth here, and seems to be more chalcopyrite, so copper mineralization, than sphalerite, the zinc mineralization. And as you can see here, it's not too far from the team zone. So as you know, we haven't really looked at any of the economics of the VMS mineralization, but hypothetically speaking, if the future operation would one day be underground in the team zone area, the QF zone is only about 200 meters away from the team zone. So hypothetically speaking, potentially could just branch across to the QF zone, take out that VMS mineralization, and potentially ship it down to the Horn smelter in Rouyn-Noranda, which is only about an hour and a half drive away. So a lot of upside to look at for sure.
Maybe you could walk through the main deposits. You have Champagne, and of course Denise, Team, Gratien, and Grey Cat, and tell us how is the mineralization hosted in each deposit? How do they differ from each other? And also give us explain how many ounces do each deposit have, what kind of grade are we seeing, etc.
Yeah, of course, of course. So this here just is specifically looking at the Champagne zone, which is so we've got the longitudinal transposed in front of the mineralized wireframe that was modelled. So as mentioned before, this is by far and away our most important zone on the property, and really carries the bulk majority of the economics at Perron. So as you can see there, if I spin the model around, it's a very vertical ore body, which is fantastic for the future operation. Gravity becomes your friend when you can do pretty straightforward longitudinal long hole stoping and just let that rock fall down and then collect it, bring it up to surface.
Is the mineralization all in quartz veins or shears, or could you explain how it's hosted?
Yeah, so in the Champagne zone specifically, it's all hosted within quartz veins. So, like I was kind of alluding to before, and we'll flip the model around east-west again. This wireframe consists of two quartz veins that are either side of a mafic intrusion, which is a gabbro. So that gabbro would have taken advantage of a previous structure that had emplaced itself or was created in the Beaupré block. That gabbro then took advantage of that structure to emplace itself, and that's no different from the mineralizing fluids that then again took advantage of either side of that gabbro intrusion and structure to emplace those two quartz veins, which are very rich in gold. So kind of, like I was mentioning before, narrow vein, high grade deposit. The average thickness of that wireframe as a whole would be roughly between 4 to 6 meters. So let's call it 5 meters on average. And that consists of those two veins and the gabbro in the middle. So each individual vein can be anywhere from kind of 30 centimeters up until kind of, in best case scenario, 1.5 meters. Your gabbro kind of averages anywhere between 2 to 4 meters, and then again the other quartz vein on the other side, same thing, 30 centimeters to 1 to 1.5 meters type thing. So very straightforward. Luckily for us, probably the not only the highest grade but the easiest system to understand geologically as well. So these veins are shear veins. We can then sometimes get extensional veins that then come off that main Champagne body that we often find in the Denise zone as well, but typically tend to be a lot more either lower grade or just a lot smaller in nature. So then obviously once you add in your mining dilution becomes a much lower grade. So really the Champagne zone drives the project here. And then depending on which other zone we're talking about, the emplacement is different, the structures are different, the grades are different.
So how comfortable are you with the geologic model here? What's the drill density?
Yeah, so depending on what area we're looking at, we can kind of zoom into the longitudinal section here. So as you can see here in the upper portion of the Champagne zone, our drill spacing is very, very tight. So in some places it's all the way up to 7.5 meters, which is kind of even tighter than you even need to build measured ounces. So it was really to prove up what we have in the Champagne zone, and that we don't have, while you'll always get a certain level of nugget effect in these high grade gold deposits, to really prove up that we do have quite good continuity in the mineralization in the system here at Champagne. So you can see even with that tight drill spacing, the high grade mineralization was quite consistent, and that really is why we're kind of so lucky to be working with an ore body like this. We do have high grade mineralization in some of our other ore bodies across the property as well. There's just not that same level of continuity that you're able to follow so easily that we have in the Champagne. So very, very nice ore body to be working with. And then
And what are the
obviously
expansion? How can you expand the Champagne zone?
expanding the Champagne zone mainly will be at depth. So there's a few little areas, as you can see here, on the sides of the Champagne zone that some mineralization could be added, sitting up against this Denise mafic intrusion that essentially cuts it off to the west, because we're looking south here. So there's potential to add a slight amount of ounces on the outskirts of the body, but really the main way we'll continue to grow the Champagne zone is at depth. And now at depth, economically, has been defined down to a depth of 1.4 kilometers vertically, and this mineralized wireframe, which is obviously mainly inferred ounces down here, goes to 1.7 kilometers vertically. So all of this has been drilled from surface. So when you're drilling, from surface, I think our deepest 10 gram intercept is at about 1.6 kilometers vertically. So at 1.6 kilometers vertically, your drill hole is coming in. We always drill from north to the south. Starts obviously way back from the surface expression of the Champagne zone and comes down to obviously try and hit the zone as perpendicularly as possible. So that drill hole is well in excess of 2 kilometers, which is definitely not a cheap exercise, not a cheap drill hole. So I think for us, it's going to make a lot more sense to continue to expand the mineralization in the Champagne zone at depth once we're already underground, whether that be with the bulk sample or the future operation. That's a decision for the future. But continuing growing the Champagne zone from surface is definitely not a cheap exercise. And when you're adding ounces at that depth, you're obviously, every ounce is important, but you're adding ounces to the back end of the potential mine life, rather than if we can continue trying to add more ounces closer to surface in some of our other zones, that could be potentially added in the kind of the first years of the mine life as well, and continue to improve those economic numbers as well.
Excellent. So let's now move to the Denise zone and speak about how the mineralization is hosted there, what kind of grades and ounces you have.
Yeah, sure. So if I come back to the geological map again, just so I can quickly explain something for the Denise zone. So as you can see, within the Beaupré block, we've kind of got a slight changing color. I would call them tan colors, I would call them. You can see to the north, it's slightly darker, and to the south, it's slightly lighter. All we're trying to distinguish between those two colors is it's the same rhyolite, the same geological dome, but we're just trying to distinguish between what we call an aphanitic rhyolite to the north, so more homogeneous, very intact. The grains within the rhyolite are kind of so fine that they're not really visible to the human eye. Versus a brecciated rhyolite to the south, so a lot more alteration. The rock has been a lot more broken up, is a lot more fractured. So that's just the differences between the two. So that line is it's not exact, but more of a rough guide. So the Denise zone, if we come down here, this just kind of looks at all of our zones hosted within the eastern portion of the Beaupré block. So the Denise zone is hosted within the brecciated portion of our rhyolitic dome. So a lot more fractured, the core is a lot more broken up, heavily altered in silica and sericite. So very silicified, very ceratized. Kind of when you're in the core shack and you're dealing with the Denise zone, if you're standing, let's say 10, 15 meters back from the core table, the rhyolite has become so altered that from a distance, it almost looks like an entire table of quartz until you walk up to the core table and take a closer look at it, and you're like, oh, okay, no, this is just a very, very messed up rhyolite. So the Denise mineralization is hosted more within quartz carbonate veinlets. So a veinlet is a lot smaller than an actual vein. So we're talking kind of 5, maybe 10 centimeters at best type thing. They can still be jam-packed full of gold. So we'll often get quartz carbonate veinlets loaded with visible gold. Obviously, when you're talking about something that is only 5 to 10 centimeters in size, you have to bring in obviously the internal dilution of the host rock that surrounds it. So overall, the grade of the Denise zone obviously differs if we're talking about the open pit portion of it or the underground portion of it, but roughly speaking is in the open pit portion of it kind of 1.5 grams type material, and the underground portion is maybe 3, 4, 5 in best case scenario gram material. So
Fully
because
diluted
of that
diluted grade?
So diluted for the resource. For the economics of it, I'd be struggling to remember those exact numbers off the top of my head, but I'm specifically talking about the resource before it was put under the constraints of the economics. So, generally speaking, a kind of a 2 to 3 gram deposit overall.
And how much how much is in the pit and how much is in the underground portion?
So yeah, overall, what's that? That's about, my maths is terrible. That's about 50,000 tons in the open pit, and then the rest of it is underground. So about 520,000 ounces underground. So bulk majority definitely falls underground. And if we it's no surprise, obviously, when we're dealing with a high grade narrow vein deposit property overall, not just for Champagne but overall on the property as well. So if I were to kind of pull up this image here, which kind of shows the overall mine plan, you can see a few modest open pits around the place. This is Gratien to the west, Grey Cat in the middle, Denise is this one, and then you've got the team pit in the background there. So I'd say about 90% of the mineralization is envisaged to be mined underground, and about 10% will be mined with the open pits.
If I remember correctly, Grey Cat, Denise, Gratien are all similar grade, 3.5 to 4 grams before dilution, and you have a similar type of 2 to 3, 400 ounces, 1,000 ounces.
Yeah, very, very, very similar. You're right. So you can see kind of here, Denise, you've got in M&I 3.4 and in inferred 6.4. Team is hovering around that 3 to 4 grams. Gratien 2 to 4 grams. Grey Cat in the 4 gram range. So yeah, most of the other zones are hovering in that area.
What's the thicknesses of these deposits, and are they all mainly veinlets?
So when we're talking about Denise, we're talking about those quartz carbonate veinlets that can be very rich, but then because of that brecciation in the rhyolite where we find Denise, you then get a lower grade halo, if you will, that surrounds those higher grade values. So because of the broken nature of the rock, that gold mineralization, or at least some of it, was able to seep out into the rhyolite itself. So often you'll get a huge value in one of those veinlets, 100, 200 grams. But then because of that brecciation, either side in the rhyolite itself that hosts no veins whatsoever, you'll still get, 1 gram, 2 grams, 3 grams type material, which obviously still helps out at the end of the day, bringing mineralized material to the surface. So If we're then talking about some of the other zones, like if we go across to Gratien as an example, I think this kind of looks at every zone across the property.
So what's the mineable widths here on average? But before we go to the Gratien.
Right. So the mineable widths on average, like I was saying, for Champagne is kind of in that 4 to 6 meter width. The minimum mining width that was used for the economic studies is 3 meters. So that's the absolute minimum that we can go down to. Sometimes because of that kind of more broad scale mineralization in Denise, sometimes that balloons out a bit. So exactly how that'll be mined, I'll leave that question for the mining engineers. But you can kind of see there some of those mineralized wireframes in Denise here can blow out a bit more in thickness. So the exact maximum that a longitudinal long hole stoping operation can go to, I'm not entirely sure, but I'm sure it can go up to maybe potentially 10 meters, maybe, but don't quote me on that one. So yeah, and then again in the all the other zones as well, you're kind of seeing similar thicknesses of the mineralized wireframes as well. Anywhere between you kind of the 2 meters was used for the minimum width in the resource, 3 meters in the economic study. So these wireframes will have a minimum thickness of 2 meters and can balloon out to, I would say kind of 6 meters on average, sometimes even more than that. Like the central polymetallic zone, as an example, can balloon out even thicker than that. So,
and when you do the feasibility study and do that, do you think the pits will increase, or do you think that those will remain kind of similar size? You don't think you will mine more?
I think there's always an opportunity to expand upon the open pits, but if we compare the pits that were and they're more shells rather than the actual pits themselves. So when the resource is built, we build a pit shell rather than a actual properly designed open pit, and then the obviously the mining engineers then take those pit shells and build the actual real open pits. So if we look here, this is the pit shells that was built for the resource that was released in May, and actually you can see the size of the Gratien pit shell in specifically actually went down to roughly I think about 200 to 230 meters. Then when we compare that to the actual final pit that the mining engineers designed, that was then cut down to probably not even 100 meters type thing. So they obviously look at rather than just the mineralization, and have to look at all the economic aspects of it. So I think there's always an opportunity to expand upon those open pits depending upon the needs of the operation, and obviously further infill drilling as well. And if we're able to continue to upgrade those resources, but importantly enough for the Perron project, those pits will be used to store the tailings for the eventual phase 2, where the mill will be built at Perron. And then rather than having to deal with our own tailings management facility, the plan at this stage is to backfill those pits with the waste from the processing plant. So those pits, even though small in nature, do play a very important role in the overall scheme of things.
So I would actually like to focus a little bit on this year's drilling, before we go into drilling that you are looking to do. Could you summarize how much have you drilled this year and what have you learned?
Yeah, so far this year, we drilled before we took a couple of month break from drilling in kind of the end of July, I believe it was. We had drilled about 50,000 meters. The drill rigs are back on site as we speak. We've got 2 drill rigs turning. They are in the eastern area of the Beaupré block. We've got 1 rig currently doing, and actually I could probably, this is actually one of the holes that we're drilling at the moment. So now that I've pulled it up, I'll start with that one. So this is one of the targets that we're currently drilling. So tests multiple modeled target plates below both the mineralized wireframes of the Team Zone, E2 Zone, and Denise East wireframes, and then actually pierces through the Perron fault and ends in the mafic volcanics of the Normantel South block. So I believe this is actually one of the first holes we're ever doing that begins in the Normantel volcanic complex, so the mine horizon that hosts not only the QF zone but the old Normantel mine, goes through the entire rhyolitic block and then ends in the mafics to the south of the Perron fault. So we'll have that entire rhyolitic sequence in one drill hole, which is pretty cool just from a geological perspective. But obviously the main point is to be testing kind of multiple targets with the same drill hole in this instance. Then some of the other targets, I don't know if that's, this is the VG from the geotechnical drilling that we drilled earlier this year. Here we go. So this is the current 10,000 meter drill program that we started a few weeks ago and will complete before the end of the year, so end of Christmas. A large portion of that, and it's got to sound pretty boring, but it's obviously a very important thing to do for the future operation, is we're doing a bunch of condemnation drilling, as we can see here in this area that is proposed where all the infrastructure for the bulk sample is going. So I've kind of seen already too many times in my relatively young career still of infrastructure being built on top of mineralized zones. So I definitely don't want that to be the case here. So we're doing a bunch of extra drilling in the area where not only the portal for the mine, but all the parking, garage, water pond, et cetera, all the infrastructure for the bulk sample, but then also for the eventual mine is planned to be going, because I don't want my mining engineers putting infrastructure on top of a potential area that might have open pit mineralization. So just gathering some extra data in this area to be absolutely sure that the mineralization in this area is deep enough that it would only be underground and that we don't have a potential to add an additional open pit in this area. So a little bit boring, but it's a very important work. Then we've got a bunch of other targets targeting the extension of the Champagne zone to the northeast. So this is quite an interesting one. We're actually now seeing that there could be a potential flexure, if you will, in the Champagne zone. So if I bring up the mineralized wireframe for the Champagne zone again, might be hard to see here. It'll be a little bit hard to see. But there's almost a small flexure that you can see here right at the end of the mineralized wireframe. And then we've got out of previous drilling, we've got a gabbro in this area that has been drilled in not an ideal orientation to get the true thickness of that gabbro, and it lines up pretty well if the Champagne zone were to have a flexure in it and actually not be a straight linear feature like we've previously thought, and end up flexing off to the northeast, then that could be that same gabbro that hosts the Champagne zone in this area continuing to the northeast. So that's one of our additional kind of geological theories that we're testing with this 10,000 meter program as well. And then a few extensions of the central polymetallic zone to the northeast and the east, as well as some more extensions of the Team zone as well. So that's the short and sharp 10,000 meters that we're doing for the remainder of the year. Then for 2026 and the $25 million
By the way, how many rigs are currently on site and turning?
Two. So 2 rigs currently on site turning. Next year, that could be increasing to 4. So if with the very generous exploration budget that Victor has given me of 25 million for next year, that will get me roughly 100,000 meters of drilling. So with that, we'll most likely see an increase to 4 drill rigs. And so we're still, as we speak, hashing out the details of that significant drill program, but we will see the company attacking on multiple fronts. So we'll continue with the expansion of the known zones and continue to add ounces in the immediate area where the future mine is planned to be. But also we obviously want to, and just going sidetracking a bit, but obviously we have our path to production now with the that we've laid out in our updated PEA with the bulk sample hopefully commencing next year and splitting the future mine out into 2 phases. So there's that path to production, but obviously we always want to continue with the exploration path as well and continue to make discoveries across our land package. So definitely don't want to get stuck in that portion of the Lassonde curve where you're just pushing towards starting the mine and that's all that's going on. We want to keep making discoveries across our land package.
Do you have any obvious targets that you want to drill, and also both regional targets, but also on the current existing deposits? Do you have any obvious, besides you mentioned the eastern flexure of the Champagne zone, but if we talk Denise, Gratien, etc.?
Yeah, so I think one that stands out for me, and it's actually a regional target over on the Ontario side, and I've got it open here somewhere, unless I've mistaken myself. No, here it is. So this image was actually in the press release when we announced the acquisition. So it was data that we had collected from the previous operator. We've then gone back to this area and done even tighter soil grids over the existing soil grid to enhance these anomalies even further. So I'm sure we'll have even better imagery to be able to provide it very shortly. But so on the property, Perron West property as a whole already, there were already 7 gold showings, historical gold showings, and 5 historical copper showings. So the Gold Hill occurrence is one of those. This is an occurrence that came out of a sonic drill hole. So sonic drilling is typically to test the overburden that sits above your bedrock to determine what kind of metals that may be lying in your overburden. But a sonic drill rig can also, I should say, pick up the first couple of meters off bedrock as well. So this 1.7 grams, which I know it doesn't sound like a lot, but when you're just going around poking holes in to test the overburden and you get a 1.7 gram sample out of the first couple of meters of bedrock where you didn't know that there were any previous gold occurrences existing, is fairly exciting, especially when it was never followed up on after that. So this was a sonic drill hole from 1987. These soil anomalies match up quite well with the rhyolitic stratigraphy that we can see here. This is just the Ontario geology, so fairly rough geology map, so you kind of have to take it with a grain of salt, but it's what we have at the moment. So matches up at this kind of 110 orientation, which matches up with the strike of the stratigraphy pretty nicely, which is kind of encouraging sign as well. So this area as a whole is probably one of my most exciting areas that I want to go and drill.
What do you think the ultimate size of the prize here could be?
Oh God, I mean that's anyone's guess. But I mean, obviously we've got a 2.3 million ounce resource to find now. I truly believe we're just getting started here. Again, I feel like I'm repeating myself a lot, but we're in a very underexplored belt from a gold perspective, and really our long-term pipe dream is to turn this into not only a future mine but a future mining camp. So Obviously, the phase one operation, that upper portion of the Champagne zone is envisioned to be toll milled to another mill that is already existing in the Abitibi. But phase two of the operation, once we have that mill in place at Perron, myself and my geology team continue to make discoveries, not only on the Quebec side but over on the Ontario side as well. If you kind of make a discovery and you build a small resource, and let's just spitball and say you've got a 50,000, 100,000 ounces here and there. Obviously, if the mill's not in place, that's not particularly economic, is it? But once that mill is in place at Perron, if we keep finding, small satellite bodies around the place, which is obviously the goal in mind, is obviously to find another Champagne zone. That's what we want to do, is to continue finding other narrow vein, high grade systems in the area. And we believe they're out there to be found. So that's always the goal. But even if we, were to find a 50,000, 100,000 ounce satellite deposit, once that mill is in place at Perron, you're only within, 10, 15, 20 kilometers max distance from that mill. And then you've just got to add your trucking cost on top of that. So that's really the vision here, is to not only turn it into the mine with the existing ounces that we have, but bring online future discoveries with whatever additional ounces that we may find, bring that all online with the mill that'll eventually be in place, and turn this into a proper camp that will not only have a 17.5-year mine life like we've got in the PEA at the moment, but will be a mining camp that will roll on for decades and decades and decades. That's really the pipeline dream here.
What royalties are there on the Perron project?
So we've put in 1.5% right across the study. That's so you could consider that as the royalty that's on the project. It's 1.5%. It's a pretty good. It's a good number.
Good. Is it sort of one company that's holding it, or it's sort of several individual small royalty holders?
No, it would probably be one holder if it's even valid. But for transparency purposes, we just put in the 1.5%.
Do you have a camp in Normetal, or how do you house your workers, that drillers and other people that are on site, geologists?
Yeah, we have houses on site, and we own a few of them ourselves now. So there's no need for a camp, because you're right beside the town. We actually own some of the rooms and houses there. So it's not, and even when we didn't own them, it wasn't expensive. Like you were looking at, we were paying like $2,000 a month, where you could house 2 to 4 people in there, and that's per month. You look at some of these mining camps today; they'll charge you $400 a day per person. It's for a camp. It's quite expensive. That's the other way that we keep our costs really down, because you'd have to add that on your all-in costs. You'd have to add that into your all-in drilling costs. You would have to add that in. And when you're paying, we own it now, so it's not much. Like, it's really keeping it clean, paying the yearly taxes. Aaron will be able to tell you much better than that. We probably own like 20 or 30, let's say, doors or like places to sleep that we have, and we've paid all that. We've paid it under $1 million.
You have a great deal of skilled trades in Abitibi, in the region, but you have lots of good miners and service providers, but there is competition for it, and all. I mean, as you have seen with quite a few companies in the past, there has been wage inflation. I mean, how do you deal with securing workforce? And
so, just to put it into perspective, we're right in the middle of the Abitibi Greenstone Belt. We're beside the town of Normetal. There's 700-800 residents. I don't believe you're going to get many. You'll get some workers there for sure, but not that many. But then, if you go 23 minutes south of us, you have the town of Lassar with 12,000 residents. So they provide all the work. They provide the majority of the workers at Hecla. So now I said we're going 23 minutes. It's about 35 kilometers south of us. Now, if you go 88 kilometers north of us, which is over 100 kilometers between the Hecla mine, the Casabrati mine, and Lassar, that's where the workers get. So the workers have to travel over 100 kilometers every morning, back and forth. Why wouldn't they just travel 23 minutes and be at, and like I'm pretty sure there's going to be competition, but I think we have the upper hand there, and that's just with Hecla. Now, with the Casa Berardi mine, well, what about everywhere else where it's going to be a fly in, fly out, like most of the other ones have camps? Whereas, now if you're a young, a young miner with a family, don't you want to come home at night every night and be with your kids? I think we have a big advantage there. The fact that we have the workers can actually go home at nighttime. The workers living in Normantal can actually go home for lunch if they wish to do so. It's so I as much as there is competition, I think we're in a really good position to be able to hire workers there. It's not an issue for us. Anytime we need workers, it's been very, even on the exploration side, it's been very it's been quite easy for us to attract workers.
When you mine the champagne zone, I'm assuming you're using long hole stoping.
That's exactly that.
And how will you do to minimize? I mean, essentially, what dilution do you expect to get when you're mining the champagne zone?
Well, the champagne zone. So what we showed there we were expecting. Not for the bulk sample, but through the phase. To the bulk sample is going to be much higher, but through the phase one, so you're looking at a grade of 16.2 grams, and what we're looking at on a fully diluted, you're looking around just a little over 10 grams per ton, which again, it's pretty impressive when you're fully diluted. You're looking at 10 grams per ton.
Obviously, also when you have nuggety systems like this, there is always a risk that doesn't reconciliate. So what drill spacing have you to define the champagne zone?
So when you look at the resource, for example, there's areas where they've put in the measured. It's rare that you actually get measured from surface, and it's quite. I mean, the Champagne zone is quite continuous. You can call it nuggety, but it's the entire. It's like it's a nugget. Like, I mean, it's very continuous. And the reason we got there was one area where we have all 25-meter spacings everywhere to get to get to get indicated. And some of them a little bit tighter than that also. But this area where you got the measured is because they from the 25-meter spacing, they ended up going right in the middle at 12 and a half, and you got the same grade that you were getting. It was really an ultra high grade area. And then they said, now go put a hole between those two. So now you're talking about 7-meter spacing, 6 to 7 meter spacing, and you were getting the same grade. So it's quite. There's lots of confidence. It's very continuous. I'm not expecting any issues whatsoever with that. The gold is there. There's been enough. Like, we've really done a lot of drill holes into that. Especially when you look at our long section, the one that I showed with those pink, with those purple spheres there, that 10 grams or more. That's a lot of drilling that we did there. We've done over 500,000 meters of drilling.
So then also, could you talk about how confident are you in the cost estimates, both on the OPEX and CAPEX?
The OPEX and CAPEX, I'm pretty confident. The numbers. So look, we're going to have a feasibility study coming out on the phase one. So the engineers, like for example, one of the things that we've done so a PA sometimes has wide variances. How do you mitigate that? Is that instead of getting like, for example, on your major equipment, instead of getting, you can go get averages, but that you're looking back, versus picking up the phone and getting quotes. And we do say that in our press release, like, we actually went out to get quotes. So so instead of looking back and it's historical, you're actually looking at right now going forward. So I'm quite confident that the numbers, there's not going to be a big variance on the number. Now, if inflation jumps on us or something, like, we're prone to everything else. But I think with I'm very confident that we're not going to have a massive number that changes here along the line.
Perfect. The feasibility study, that is planned for mid next year?
No. So we're going to be doing 2 feasibility studies. The first one is going to be only.
Yeah, I meant the first one for the phase one. Yes.
No, at the end of the first quarter. At the end of the first quarter, so probably March. If it slips, maybe it'll be April. But they've been pretty good. They've been pretty good to deliver within the time frame that they've promised.
And will that will just focus on the phase one, or will it even mention, or will it even have new details on phase or estimates on phase two? Or
no, it'll be concentrated on phase one. It will really be concentrated on phase one. The phase two is it's gonna start. At some point we're gonna start the phase two feasibility, and it's gonna pretty much they're pretty much gonna be going into. You're gonna have two of them going in parallel at the same time.
just to clarify here, you're looking for toll milling and not ore selling. Is that fair? So you retain ownership of the doré bars once they are produced.
Once they are produced, absolutely. That's how we're contemplating it right now. Absolutely.
And what mills are up for consideration?
Well, you've got for me the one that I would like to go to is up to Casa Berardi. The reason being is that you're going north in the forestry roads, so you're not going through it. If you're doing 1,000 tons per day, you're looking at around 12. You're looking at around 30 some odd trucks a day. So, if you would put those 30 trucks a day and you go to Val d'Or, for example, or if you go to Holt Holloway, you're going to be going through towns and cities. Where going up through a forestry road where you're not disturbing any cities, it's a lot easier. Not only the distance is shorter, but it's not the distance because once it's loaded up on the truck, that's not what expensive. It's really you're loading and unloading, and if you're going through cities, they may put restrictions on what time of the day you're going to be, your trucks are going to be on the road. And so yeah, my best one would be going up to Casa Berardi. But yes, can we go to Holt Holloway? Holt Holloway is great. It's in care and maintenance. Would be enough production there to get them to reopen it. We could go to our partner at Lamaque, send it over to Lamaque. It's 2.5 hours away. Again, because it's high grade, it doesn't really matter.
Can you give some sense of the hauling costs here and how dependent it is on per kilometer, or or what it adds to per ton?
Yeah, so it's not a big number. You're looking at around $30 to $40. You're looking at $30 to $40 a ton. And that's being really conservative. That takes it to 2.5. That takes it to almost 200 kilometers.
So essentially, hauling cost is no issue.
No.
The mills, Casa Berardi, is there excess capacity? How much excess capacity is there, and what's your relationship with Hecla?
Yeah, we have a great relationship with Hecla. It's one of them that we're talking to. And there will be a lot of spare capacity because they're going to be dramatically reducing the amount of ore that they're taking from their underground operations. So it's a 4,000 ton a day mill because they're going to be permitting another open pit there. Originally, they were going to actually shut down the underground operation while they were permitting the open pit. So there's going to be a lot of capacity there. They can like 1,000 tons a day is not an issue at all.
When do you expect to announce, or when would you like to have announced a toll milling agreement?
Soon. It has to be. I have to sign up somebody soon because it has to be. It's going to go. It's going to be part of the permitting process. So the way it works, they come back to you, the permitting process for the bulk sample. So they're going to come back to you and say, okay, great, we like your plan. We're going, here you are. We're going to give you X amount of tons. Now, where are you sending it to? And that's where you have to have your LOIs already signed. So we're working on that. We're trying to work it ahead of time that even before they come back with those questions, we'll have an LOI signed with one or two of the mills.
All mills here, they roughly have, I guess they have a CIL circuit. So essentially processing it won't be an issue.
As long as you've got your CIL circuit, the gold gets all extracted. You need at the end, you need a CIL circuit.
But with Casa Berardi and Lamaque, they have CIL circuits.
Yeah, absolutely. You'll be getting doré bars at the end.
Roughly, how much more expensive is it to toll mill? A ballpark range for the per ton cost.
Well, I can show you the effect that it has. I can show you the effect that it has on the. So they've done the numbers extensively. How it would affect. So, for example, your all-in sustaining cost for phase one is $1,165, and your phase two is $1,027. So it's actually costing you about 100 and just under $140 just under $140 a ton more by sending it to another mill. But there's everything's included. All the extra costs are all included, including because it's not just
Wait, this is per
tolling.
ounce, right? Yeah. Okay.
Yeah, per ounce. Sorry,
Yeah.
not
Yeah. Okay.
per ounce, per ounce. So that's what I meant, per ounce. So on a per ton basis, it'll actually be a lot. It'll be a lot less. So that's where we did the trade off. That's where we did the trade off studies. It's just above in our presentation. We presented that before presenting all the doing the economic analysis. We presented all those numbers, including we have it in what they call the Perron project, the capital and operating expenditures.
When the mill is built, you switch from contract mining to owner operating mining. Why is that you switch then, and what's the advantages with both?
Well, there is a cost saving operating it on your own, and at that point you should have had a well trained team by that time. So you might as well save the money. I mean, if you look at phase two, the way the costs dramatically come down, your all-in sustaining costs come down quite dramatically. So that's really the reason being. It's really cost saving. And you will have gone through 4 or 5 years of this already, so it's pretty good.
When you say that you're avoiding a tailings store facility but having a pit for tailings, is that just for phase one or even for phase two too?
No. So phase one, you actually don't
Oh
need it.
yeah. Oh, sorry, that's
It
true.
goes on the other side, yeah. And phase two, it's actually what the government is. So you're one of the, our open pits are actually quite small. So the way we do it, is we would be emptying out we'd be starting off with starter pits and just emptying out the pits. So then you could backfill the rock back in there. That's actually how the government wants things run anyways. They prefer that. Now, if you have a big open pit, it's quite difficult. Like, how do where do you store all the rock, right? Where in our case, the way it is right now. But again, if that's the way it's contemplated. But if you end up finding more ounces there, and it becomes bigger, then we'd have to put a tailings management facility. But again, this is how you mitigate it, right? Because instead of delaying a project, you're actually mining it through toll milling. And then you could turn around and make a decision at that point and say, you know what, these open pits are too big now. We can't just backfill. We need a tailings management facility, and then you just do it. This is the optionality about having a high grade project. Like, again, I'll say that if I had a 1 gram deposit, like, I cannot transport 1 gram to anywhere. Like, it's impossible. Like, you're going to lose it in transport costs alone, let alone toll milling.
So timing of receiving the bulk sample is, when do you expect that, and what's the risk of the magnitude? How much could it be delayed if it takes longer?
No, it shouldn't be. 3 to 6 months is a good time. We've really worked on the permit application quite extensively for a long time. Before that, once you've got your LOI signed with the mill you're sending it through, because they have to get permitted to receive our ore anyways. So, and again, our ore is really, really clean. It's really clean. Like, a lot of it just comes out as free gold, and there's really no sulfides not of any importance that's in there. I'm not expecting any delays, and especially today where governments are really moving forward to try to they're trying to move fast to get projects permitted. So yeah, so I'm really not 3 to 6, like, sometime in Q1 at the latest. I can't see it going beyond that.
And you applied for 40,000 tons. You might not get that. I mean, what's sort of the minimum that you think that you at least would get?
The minimum in my mind. So the minimum that you get is 15,000 tons. That's in law, but you're allowed to apply for 1% of your total M&I. So technically, we would have been able to apply for 80,000 tons. And so we've showed them scientific reasons why we need 40,000 tons. So I don't think we'll get less than 20,000 tons. And if I go back and look at bulk sample that Wallbridge had applied for back in 2017 or 2018, the government gave them 35,000 tons. So we're not the first ones that are asking for this big bulk. And so is Eldorado had asked for their Ormac deposit. I believe they had 25,000 tons, and actually they applied for a second one now, and they're giving them more. As long as it's environmentally here. And you're doing things that it's environmentally friendly. I think it's okay. I can't see any issues.
What's the cost to just to get and take out the bulk sampling, get down with the decline, etc.?
Yeah, so that would be about $30 million. So that $30 million, you deduct it from the $146 million, and then your gold sales, you would deduct that also from that $146 million.
Your capital requirement for next year is funded.
Yeah, for exploration, it's funded. It's going to be the only thing that would probably need money would be the bulk sample at some point, like later on, much later on in the year. It'll probably be later in 2026.
Besides equity, are there any other alternatives that you're looking for funding the initial capex here?
Oh, absolutely. I mean, you can. I'm usually not that comfortable with debt or taking on other forms, but you can take on debt here because you're going to be producing immediately after that, and the amounts that you're going to be, even if they would only give you 20,000 tons, you'd be getting about $50 million from that, which is more than enough. That if you borrow 30 million, you get 50 million. You just give them back the money. It's not, you're looking at about a year later. So the question is trying to find financing that they would be willing to take, funding without 4 or 5 years of funding on it. So because sometimes when they want to lend you money, they want to lend you money for years, right? They just love making their interest on it. So,
But I guess stream is probably out of the question.
oh no, not.
Or a royalty for that matter.
No. You got to remember, you put on a stream, you put on a royalty, it's there forever. It's there forever. Like no, not. It's too small.
Yeah, I know. I just have to ask. Yeah.
No, absolutely. You have to ask. Like I get, if you have $1 billion project to put up, or $600-700 million, then you have no choice, right? You need a stream, you need a royalty, you need a debt facility, you need it's like you're trying to put everything together. This is quite small. This is really, and again, it's a small capex, but for a really interesting, you're still going to be producing 100,000 ounces a year. And because the other $191 million that you would need for phase two, that's all going to be funded. It's called growth capital because that's all being funded from your sales of your production from year 1 to year 4 of your production. So this is where I say you actually mitigate the financial risk here. You're just doing it step by step by phase.
So essentially, the goal is to sometime in mid or second half of 2028 to be mining essentially your toll milling operation. And could you walk through the permitting process?
Yeah, I mean, one of the last, the environmental studies and all that, we've started those already. Then one of the last steps is what they call here in Quebec is what they call the BAP. It's an acronym. It's BAP, and basically what it says, the AP in the middle, it's for public hearings. But again, especially for the phase one, so we're going to be doing public hearings for basically a portal and a decline and a ramp that you've already permitted me for. Like I know it's different, but the portal, the decline, the ramp is the same size. It's production size that we're doing. So I really don't see much. You'll still have to do the BAP process, but I think it's pretty straightforward. And we're really lucky that we do have community support and First Nation support, and we have politicians supporting the project. It's a simple project. They want this project to move forward. So,
how are your First Nations relations, and do you deal with one or more groups?
One group. It's one group. It's the Picogan. They're great to deal with. Like we've been dealing with them since we started the project. It's on their territory. They're also the group. So Casa is not too far from us. It's 88 kilometers just north of us. So they also have an IBA with the Picogan have an IBA signed with Casa with Hecla. And so I don't. I'm not expecting anything really. You're gonna have to go through all, making sure that everything gets, here I'll say like all the T's get crossed and the I's get dotted, but it's not. They really support the project. They want the project to go forward. This is good revenues for them. They'll be getting, some type of sharing. It should be something like Casa I guess, or So yeah, no, it's really great. It's really nice working on a project where you have great community support and not only community, and then you have First Nation support. It's very difficult when you step into a project and you would have guys, not in my backyard and not here, not there. This is really like you show up to site. If one day you're in North America, I got to take you up to site, and we'll take you to the city council, and you'll see that even the residents that if we bump into residents, they're hey, when are you opening the mine? When is the mine going to open? Like they really want this project to go forward. And when you have the will of the people, usually the politicians will follow the will of the people. That's what they're there for. So, and the will of the First Nations. So they're all for it. So
When would you like to have the impact benefit agreement in place?
as soon as possible. As soon as possible. It should get. I believe it's going to go in steps. So we're doing a collaborative agreement. From that agreement, that's going to move to an MOU, and then from an MOU, it's going to move to an IBA, to an impact benefit agreement. So that should be sometime in 2026. I'd say later in 2026. But again, that I don't have control over. It could slip into 2027, but it'll be in place way before production. So I'm actually hoping that it will be done sometime in 2026.
Sometimes you see when it comes to exploration and development companies that are becoming producers that things go wrong. Mining is tough, and also building is tough. That for that matter. So how comfortable are you in your ability to execute on building and also mining, Perron?
Yeah, so we are bringing in a team of professionals that have been a team of mine builders. But aside from that, the way we're doing it, you're mitigating the risk, because I know we talk about two phases, but technically you have three phases. So you're doing your bulk sample first. So now your bulk sample, you can't tell me, oh, it's just a bulk sample. It's not just a bulk sample. It's actually real mining. You can call that test mining, because everything that you're doing there is actually production size. Just you're doing it in smaller volumes. So if there's going to be any technical issues, you're gonna spot them. You're gonna be able to, again, you're gonna be able to mitigate that right away. And we're not jumping from, we're jumping. So you have your portal, you have your decline, your ramp, all production size. By the time you jump into phase one, it's more ramp development, and you just keep going from what you're already doing. Then you start working. You start getting revenues. Your open pits. You start working on those. But that again, your phase two is going to be while your phase one is in production. Again, that's where I keep saying it. It's the best way to be able to do it, and that's because the project is there for it, is doing it this way in a phased approach, especially for a one project young company. You want to do it this way. You just mitigate all the risks, and with substantial production.
And what do you think could trigger a company, such as Eldorado or another company in the Abitibi, or another company that wants to get into the Abitibi to make a move on you?
Yeah, look, at some point, I'm very limited in what I can say. But what triggers it is, if I'm a major, I'm looking at the amount of ounces. Then I look, can the ounces be grown? Which, yes, you can. And what is your land package? You have a big land package to be able to even grow this even further. And that's what we're doing. Like, we've grown it from 45 square kilometers to 200 square kilometers, and I hope shortly we could say we have 400 square kilometers. Like, I just want to continue growing it. There's a lot of smaller companies that own and individuals that own land there along the deformation zone. So we've definitely got our eyes onto that. But again, we don't want to overpay. When we did our last transaction, I think it was a great transaction. Got 152 square kilometers on a deformation zone that's basically there. There's a mine there, because we're going to build one, and the transaction was for $150,000 and 1.5 million shares. But the 1.5 million shares are escrowed. The first 6 months they get 10% released, and then it's every 6 months they get 15% released. So it's pretty, and those are the type of deals that I want to do for the company.
So now, could you summarize the catalysts for the coming 12 months?
Yeah. So the on the exploration side, the catalysts are going to be making increasing the zones, making new discoveries, also exploring on the starting the drilling program, exploration program on the Ontario side. And then on the production side is looking for the out for the agreements that we're going to have with the First Nations on the Quebec side, with the First Nations on the Ontario side, receiving the bulk sample permit, the feasibility study for the phase one, which will be sometime at the end of Q1. Yeah, there's a lot of press releases coming out between now and going over the next 6 months. There's a lot of activity going on. Again, it's along both these roads here, both on exploration and on the development side.
Where do you envision Amex in 2 years from now?
Yeah, I look. There's two things. Either we'll still be around producing well over 100,000 ounces a year, but in this market, the way the M&A is happening, why would somebody let you make a couple of hundred? I'll leave it at that because I'm very limited on how I can say things. So my thing there is like, why would any one of these producers, even mid tiers or even larger ones, why would they leave you there making a couple of $100 million a year? It's of AISC and then growing it also. As you're making more and more discoveries, you really become how can I say it? You really become appetizing to like we can provide a lot of good revenues and good ounces to a lot of to a lot of different companies. Like just look at what Simon Marcotte with myself, what we've done at Northern Superior, where we ended up selling that company. And there was there's 2 million ounces at Philibert at 1.2 grams more or less, and plus another 2.5 million ounces in different deposits. So I think if as long as the environment, the gold, the precious metal space stays like this, I doubt very much we'd be around in 2 years from now. But I have no problem being around because we'd be making so much money for our shareholders if we are around.